Good morning, friends. Before starting fifth virtual seminar of AOC for financial year 2022-23, I request all the members to stand up for ICA motto and put their right hand on their heart. ICA motto, please.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Good morning, respected past conveners, professional colleagues, and today's our esteemed speaker and friend, CA Anoop Bhatia ji from Jaipur. As all of you know, that it's a time for filing of the income tax return for your clients. A lot of change in the income tax utility and introduction of section 194 TDS on benefit and the perquisites of a business and profession is introduced in Finance Bill 2022. Today we have learned speaker C. Anoop Bhatia ji, who will discuss in detail on ITR utility and section 94R during the session. I request all the participants to ask questions during the session to better understanding and the interactive session. Before we welcome our today's speaker, CA Anoop Bhatia ji, I request coordinator of program, CA Rochak Garg, for a brief introduction of Shri Bhatia ji. Rochak?
Yes, sir. Thank you. Hi, I'm CA Rochak Garg here. I would like to introduce CA Anoop Bhatia ji from Jaipur. He is not just, he's been in our fraternity since almost a decade now. He's also insolvency professional and an LLB. So in the start of his career, he started working as an state head of accounts in HDFC Limited, Jaipur for 7 years. And since 2011, he's been practicing as a chartered accountant in ABSM and Associates Chartered Accountants firm, Jaipur. He has also written a book on summary book on direct taxes. And he also has a social media presence through his YouTube channel, uploading more than 400 YouTube videos and having a watch time of more than 1,000 hours and having subscribers of more than 40,000 and counting. He's also delivered lectures as a visiting faculty for income tax and IP related subjects at various branches of ICAI, Reserve Bank of India, Income Tax Department, Rajasthan, Jaipur, Office of CNAG, Jaipur, Audit Wing, NIIT University, Nirmarna, PNB Regional Trading Center, Jaipur, Oriental Insurance Company, Zonal Office, Jaipur, and the Institute of Cost Accountants of India, Jaipur branch. So please, CA Anoop Bhatia ji, welcome to our Andheri study circle. And I would like sir to please take it over and continue. Thank you.
Thank you, Rochak Bhai, for kind introduction. And I'm also thankful to Andheri Oshiwara CPE Study Circle of WIRC of ICAI. And my special thanks to my dear friend Jitendra Kothari ji and today's Deputy Convener, Coordinator, as well as all the eminent members today present in this virtual meeting. My dear friends, it's a pleasure for me that today, sitting in Jaipur, I'm at Bombay, and that too in a rainy season, so I can feel the kind of rains you all would be enjoying, and I have this opportunity to enjoy that along with you. See, today's topic is very important as it pertains to Section 194R as well as ITR-U concept. And both are new things to us. And we should put up our mind and understand that, okay, as a professional, I think that if any new provision comes to us, then we need to first think about it as a professional and make up our mind that are we ready with that provision? Are we ready to adopt on our own or not? Once you are able to adopt it, once you are able to understand it, then you are able to circulate it to the public at large, to your client. So these kind of sessions are very important because they let us think that, okay, what this provision is, what are its attributes, what could be its pitfalls, what are the issues which are not yet clear. And while I will today discuss with you these provisions, I will try to put up some practical understanding of mine. And I would also like to learn from your experience or your queries, which we will be discussing in today's session. So, my dear friends, I'm trying to put up my ideas on this or my understanding on these two concepts with the help of a PPT. So, Rochak bhai, if you permit, I will go ahead with that presentation.
Yes, sir.
Thank you. Is it visible?
Yes, sir. It's
Yes,
visible.
sir.
Okay.
Yes, sir.
Okay. So first, we are going to discuss the concept of 194 ITRU, and then we will take up the second portion of 194R. Mind you, my dear friends, before starting this discussion, I had certain points in my mind that, okay, which all things we need to discuss in this kind of session today. So the key points for discussion in my mind were that what is the present process? This I am discussing in the perspective of this ITRU concept. What is the present process of ITR filing? A brief idea on that. What is the purpose of this ITRU concept? Let's understand that. That is very important. What is this ITRU? Let's see that what is the format of this. We will also discuss over that. Who may file ITRU and who can't file ITRU? How many times ITRU may be filed? How to file such ITR online? Up to what time limit ITRU may be filed? What is the time of tax payment for ITRU? Does it need to be paid before filing ITRU or it can be paid later also? How much additional tax will be payable in this ITRU concept? These are the points which we'll be discussing in terms of ITRU. And in the second portion, we'll go ahead with our discussion on 194R. So first thing which I thought about was that, okay, let's discuss what is the present process of ITR filing. And as you all are well aware about, as we have been practicing over that we have three main subsections of section 139, which are dealing into ITR filing. That is 139.1, 139.4 and 139.5. To the first one, we call regular return or mandatory return. To the second, 139.4, which is a belated return. And third one is a revised return. And if you see in the past time, the time for filing the return has been substantially curtailed. If I am correct, down the line 3 years ago, we were filing the return up to 1 year from the end of relevant assessment year. That is up to 2 years from the end of financial year. And the government is substantially reducing this time limit in terms of allowing a belated return or allowing a revised return concept by saying, if I read 139.4, which says any person who has not furnished a return within the time allowed to him under subsection 1 may furnish the return for any previous year at any time before 3 months prior to the end of relevant assessment year. So even the time limit which was up to the end of assessment year has been curtailed by the Finance Act 2021, that is with effect from assessment year 22-23 up to 9 months from the end of relevant assessment year only. And since this amendment was effective 1st of April 2021, So it has applied even for the assessment year 21-22, which we have filed last year. But because of Corona impact, the due date was further extended. But this year, mind you, my dear friend, this year, assessment year 22-23, we have first due date in normal non-audit cases, 31st of July. And if we want to file a belated return, then it would be 31st of December. So practically speaking, if these time limits have expired, that is the extended time limit, 139.4 time limit of 31st of December 2022 would get expired for the assessment year 22-23, assessee prima facie would not be able to file the belated return at all. Now you can say, why, Anoopji, you are saying prima facie he can't? See, a question which came in my mind was that till date, if a person's belated return time limit or a revised return time limit has expired, and he or she is wishing to file a return, say with the help of you, with the help of practicing chartered accountant, what would be the course of action which is available with you? You all would agree with me that certainly we could have been trying to do so with reference to provisions of section 119 with a delay condonation request. So if we were doing it with a delay condonation request, and this concept of ITRU now coming into place, the first question which is of paramount importance is that whether the concept of section 119, that is filing a belated return or filing a revised return with delay condonation, has come to an end. A very, very important question, my dear friend. And there my answer to you, which is as per my understanding, I may be incorrect in your opinion even. In my opinion, the ITRU concept has not finished the concept of 190, meaning thereby that ITRU is a concept which is in addition to 119 in my understanding. So while I'm going to discuss with you the concept of ITRU, you can also keep into mind that, okay, what I can do in 139, this 119, and what I could do in 139.8a. We will keep on discussing that as I proceed. So prima facie, what I'm trying to put up is that ITRU is available when the time limit of filing a regular return or a belated return or a revised return has come to an end. See, in one such session, somebody asked me, Mr. Bhatia, suppose if I want to file the ITRU, even if I have the time limit available under 139.4 or 139.1, would it be available? My straightaway answer to that question was, no, sir, it is not possible, because ITRU time limit would start after the expiry of 139.4 time limit. Now, before I go into that technicality, I'm first trying to put up the purpose of ITRU concept in the mind of the government of India. That government thinks that we are providing you extra time limit to file the ITR. Through this, we are motivating the taxpayer towards the desired objective of voluntary tax compliance, starting with filing of correct tax return. And we are ensuring additional revenue realization and facilitating ease of compliance to the taxpayer in a litigation-free environment. To all these things, in my mind, the third point is very important. Yet, all three of them are important. But the third one is saying ensuring additional revenue realization, and it is nowhere mentioned in the law. I have just picked it up from the background material, which is there by the finance bill and all. You can get it, that the government says that, okay, we want additional revenue realization, and we are at the same time facilitating compliance to the taxpayer in a litigation-free environment. See, my dear friends, that government on one side has reduced the time limit of belated return from 1 year up to 1 year from the end of relevant assessment year first to the 9 months of the relevant assessment year on. Then government has again extended that time limit and said that, okay, ITRU can be done up to 2 years from the end of relevant assessment year. But you have to come to us by way of paying additional tax liability. And as you all would have read that, okay, there is a big amount of additional tax liability which is required to be paid. And the other thing which I would like to add here is that in the recent past, we have seen the concept of annual information statement has made up a large compliance on the part of assessees at large and I can say a suo motu compliance on the part of assessee, and rather it has made the job of a chartered accountant who is practicing to a larger extent, I can say, if not easy, then certain at least. Why I'm saying certain? Because in 3 years, 4 years ago scenario, if a person used to come to me, I would have been probably looking at Form 26AS. And if e-campaign is to an extent available, then I could have been gathering some information before he talks to me that, okay, I had this kind of income. But in today's scenario, when somebody comes to me, my article or me would be simply looking into AIS, understanding what are the transactions available to him, and a summary of that, as I can get a printout or I can simply give him a snapshot. Sir, this is what is there with you. You tell me about them, and then anything else left in them, then please tell me that so that I can file your return. So this availability of data, the usage of CPC is using artificial intelligence, more and more compliance being put up on the part of the assessee. This kind of database, which is being used by CPC now, is creating too much of the kind of compliance on the part of assessee as well as chartered accountants to be on toes while they are filing the return for their clients. So ITRU is for whom? Who is not awakened in the regular time limit or even in a belated return time limit. And still he or she is thinking of that, okay, let me file the return. Now, what prompts an assessee to file ITRU, in my opinion, and I thought about it. So I thought that, okay, what drives an assessee towards 139.8A? Say, for an example, a client comes to me, and as I tell you, in my understanding, none of my client or any query I have received as such prima facie saying that, okay, sir, I'm the person who is interested in filing ITRU. Rather, it would be for those people who may be discussing with you, look, sir, I forgot to file the return for assessment year 21, 22 or 2021. And I think that I had tax liability there and I should have paid. Now I can't sleep properly because I have in my mind that if tomorrow it will be on surface, what would be to my case? So what was driving me to think about 139.8A, my dear friends, is the penalty for underreporting and misreporting of income. And as you all know, that section 270A provides for such kind of levy in two formats: prima facie underreporting, that is 50%, and if the case turns into misreporting, that is 200%. So what would prompt an assessee to move towards 139.8A, that is ITRU, which is inserted by the Finance Act 2022? In my opinion, it is section 270A. This is the terror which will bring an assessee on the platform of 139.8. And if somebody is not terrorized with this, my term may not be well acceptable to you, but sometimes I use it, a kind of terror means to an assessee. So what is the terror available to the assessee, or which will throw him towards 139.8A or push him towards 139.8A? In my opinion, it is 270, because people would argue with you. They would say, why should I go with the concept of ITRU? Okay, sir, you don't go. And do you think that wherever the department initiates 270A, my dear friends, in my opinion, you take it for granted, prima facie department would treat it not underreporting. They may try to fit up that particular additional income or income not reported as misreporting, and which means 200% of the tax payable on underreported income. So say 1 lakh rupees is, which is a very meager amount I am saying here, 1 lakh rupees is the income which is not reported in ITR, should have been reported. And now assessee is thinking of ITRU. Suppose he doesn't go into ITRU, then the 1 lakh rupees, say 30% tax liability, 30,000 multiplied by 15%, that is 15,000 or 60,000. This could be the penalty rate. And suppose if he or she wishes to comply with the 139.8A concept, then 30,000 tax multiplied by 25%. If you are doing it up to 1 year from the end of 11th assessment year, and if you are doing up to 2 years from the end of 11th assessment year, 50% of the tax liability. So that could range between 7,500 to 15,000. So some appearance coming on the part that, okay, going towards 139.8A prima facie appears to be beneficial as compared to the concept of underreporting facing or misreporting facing. So this was my mindset. Now, what is ITRU? Let me discuss it with reference to reading of 139.8A, which is newly inserted by Finance Act 2022. Let's all read it. Any person, whether or not he has furnished a return under subsection 1 or 4 or subsection 5, very important, my dear friend, whether you have filed a return under 139.1 or 4 or 5, or you have not filed, on both the sides you are into this option. You can be into this option. And mind you, it is not mandatory. It is the call of the assessee. See, the department cannot force an assessee that you have to file ITRU. It is only the assessee who has to choose. And please also note that department cannot even issue an intimation to the assessee that you have not filed the return and why don't you think of filing ITRU? That is not their prerogative, in my opinion. I read it. Any person, whether or not he has furnished a return under subsection 1 or 4 or 5 for an assessment year, herein referred to as 11th assessment year, may furnish. Mind you, my dear friend, it is may furnish, not shall furnish. May furnish an updated return of his income or income of any other person in respect of which he is assessable under this Act for the previous year, relevant to such assessment year, in the prescribed form, verified in the prescribed manner, and setting forth such particulars as may be prescribed at any time within 24 months from the end of relevant assessment year. So it is one, may furnish. Second, I would like to highlight this yellow background thing, income of any other person in respect of which he is assessable under this Act. So say for an example, there is a person who is a LR, legal representative. The person who has deceased had not filed a return or had filed the return but did not properly give the disclosure of income in the ITR. Now this legal representative is thinking of that, okay, let's file ITRU for the deceased. Can he do so? In my opinion, the answer is yes. And then if he or she, whosoever, or maybe it is a company, maybe it is a firm, maybe it is an EOP, BUI trust, whosoever is wishing to do so can do so within 24 months from the end of 11th assessment. And one very interesting question, my dear friends, here is that while you make up your mind of filing ITRU, then naturally you might have heard of that, okay, there is a specific form ITRU. So whether ITRU itself is a complete form or you have to also file a form which is a regular ITR 1, ITR 2, 3, 4, 5, 6, 7, whichever is applicable to you, that is also a very important question. We will give some time on that concept also. I'll come on that. So till this discussion, I would like to summarize, in my opinion, who may file an ITRU, an assessee, whether individual or non-individual, any assessee, whether audited or non-audited, and any assessee, whether resident or non-resident. So there is no limitation as such that this category person may file, this cannot. Prima facie, all assessees, whether or not resident, non-resident, individual, non-individual, audited, non-audited, can do so. But this 139.8A has certain limitation provided in it that when the updated ITR can't be filed. And one of the biggest question, Jitendra ji, here would be, some people who could not file the return, say for assessment year 2021 or 21-22, but having income below 5 lakh rupees because no tax is payable. They might also come to us and ask that, can I use the facility of ITRU? That is an important question. Largely what I understand, that ITRU is made for them who are thinking of paying the tax liability to the government. So prima facie an understanding may be developed that for persons who are having total income as an individual up to rupees 5 lakh and eligible to claim a rebate of 87A, and they thinking of ITRU because they are not going to pay any tax, then there is no question of additional tax. The question comes that how the ITRU may be applied over them. We will discuss this interesting question also. But I am first trying to put up before you this category of people who can't file ITRU by way of referring to 5 different provisos which are provided in 139.8. And let us read them one by one. The first proviso to 139.8A, my dear friend, says, provided that provisions of this subsection shall not apply, meaning thereby that you can't file ITRU if the updated return is a return of loss. So if you think of that, okay, I had certain losses which I could not report, or could not report in my original return, let me put them up into an updated return? The answer is no, you are not allowed to do an ITR. Or has the effect of decreasing the total tax liability determined on the basis of return furnished under subsection 1 or 4 or subsection 5? So you can't decrease. Where you have earlier filed, you can't decrease. You have to only increase. Or results in refund or increases the refund due on the basis of return furnished under subsection 1 or 4 or 5. So if you are wishing to claim a refund or you are wishing to enhance your refund, if you are wishing to reduce your refund, you can do ITRU. But if you are wishing to claim a refund or increasing your refund, ITRU is not the right proper channel for you of such person under this act for the relevant assessment. So these are first three categories, my dear friend, who have been specifically prevented from availing the option of ITRU. Now I come to second proviso, which is again important. Provided further that a person shall not be eligible to furnish an updated return under this subsection, where a search has been initiated under 132 or books of account, other document, any assets are requisition under 132A in the case of such person. So those who have been subjected to search and seizure can't avail the benefit of ITRU. Those who have been subjected to survey under 133A, other than subsection 2A, survey of 133A, that is other than TDS survey. So where there is income survey or where there is event survey. In these two cases, you can't avail the option of ITRU. Or a notice has been issued to the effect that any money, bullion, jewelry, valuable article, thing seized or requisition under 132 or 132A in the case of any other person belongs to such person. Again, very important point, sir. X has been subjected to search and seizure, and Y is going to, or Y has received any notice, not going to, Y has received any notice because his assessment are proposed to be opened under section 147, previous regime was 153A, that any money, bullion, jewelry, valuable article, thing which are seized during the course of search on X pertain to Y. Or a notice has been issued to the effect that any books of account documents seized or requisition under 132, 132A in the case of any other person pertain or pertains to, or any other information contained therein relate to such person. So even if your money, bullion, jewelry, valuable article, thing is not found in the case of search of X, matter pertain to Y, but for Y, any books of account document seized during the course of search of X are pertaining to Y, then also Y can't avail the benefit of ITRU. And in such cases, for 2 years, you can't go into ITRU. And practically, my dear friends, if as on date I talk about you are thinking of filing ITRU, you can't file ITRU for a person beyond 2 years, only maximum 2 years. One, that year where 24 months from the end of assessment year has not expired. Second, that year where 12 months from the end of 11th assessment year has not expired. And beyond that, ITRU is also fail. Let me discuss third proviso. Provided also that no updated return shall be furnished by any person for the relevant assessment year, where an updated return has been furnished by him under this subsection for the relevant assessment year. Now, this is a very important point, that you can't think of filing a second updated return. It is one-time opportunity for one assessment year. I can't call it once in a lifetime opportunity. I can only call it one-time opportunity for one assessment year. Or any proceeding for assessment or reassessment or recomputation or revision of income under this act is pending or has completed for relevant assessment year in his case. Very important, sir. Sometimes people ask us that Mr. Bhatia, say a 143(1) intimation is issued already on me. I have filed my return, or say I have also filed revised return. And for both of those cases, 143(1) is done on me. Can I go into 139(8)(a)? My answer is yes, sir. Why not? Because 143(1) is not a assessment. It is only an intimation. So where the assessment, reassessment, recomputation, revision has opened up, then naturally you can't go into 139(8)(a). Otherwise you can go. And you can go whether or not you have filed a return earlier for the same assessment year, or the AO has information in respect of such person for the relevant assessment year in his possession under Smugglers and Foreign Exchange Manipulators Act, or Prohibition of Benami Property Transaction Act, or Prevention of Money Laundering Act, or Black Money, Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. And very important point which I backgrounded in this sky blue color, and the same has been communicated to him prior to the date of furnishing of the return under this subsection. So where the person has not been communicated, he may avail the option of ITRU. Where he has been communicated, he can't go. There are few more, three more conditions. Information for the relevant assessment year has been received under an agreement referred to in section 90 or 90 in respect of such person, and the same has been communicated to him prior to the date of furnishing of the return under this subsection. So under DTA, government has received certain information for a person and that has been communicated to him. Assessee thought of, look, I could not do so. I could not include that information in my return. Let me do ITRU. He would be barred. Or any prosecution proceeding under chapter 22 have been initiated for the relevant assessment year in respect of such person prior to the date of furnishing return under this subsection, or is such person or belongs to such class of person as may be notified by the board in this regard. So these are continuous exclusions from proviso 1, proviso 2, proviso 3. And list does not end here, my dear friend. There is a fourth proviso for that. Provided also that if any person has sustained a loss in any previous year and has furnished a return of loss in the prescribed form within the time allowed under subsection 1 and verified in the prescribed manner and containing such other particular as may be prescribed, he shall be allowed to furnish an updated return where such updated return is a return of income. Now, Jitendra ji, please note, this is a very important point, my dear friends. Please note, this is a very important point. Say I filed my return with 50 lakh rupees loss. Now I want to reduce my losses to rupees 30 lakh. So that way, what I am doing, I am reducing my income from minus 50 to minus 20. Okay, say I am reducing my losses by 30 lakh rupees. So I am coming down from minus 50 to minus 20. Let's say example is like this. Can I do an updated return? Can I file an updated return? Government is saying you can reduce your loss by way of converting such updated return into a return of income. I am still not converting my updated return into a return of income. I am simply reducing my losses from minus 50 to minus 20. So it may appear to be that such kind of loss return may not be entertained by the government, even if it is benefiting to them. And there are some other logics also, my dear friend, which I'll discuss with you. And by way of having a discussion over all of those points, we may conclude that, okay, how we should proceed, where we can proceed, where we can't. So one thing is very sure in this fourth proviso, that where you sustained losses, you reported them. And now you wanting to reduce the losses, you can do it in ITRU provided you are converting your ITR into a return of income. This is one point. Now let me discuss fifth proviso. Provided also, if the loss or any part thereof carried forward under chapter 6 or unabsorbed depreciation carried forward under subsection 2 of section 32 or tax credit carried forward under 115 JAA or JD is to be reduced for any subsequent previous year as a result of furnishing of return of income under this subsection for a previous year, an updated return shall be furnished for each such subsequent previous year. Now I have an objection here. What is that objection here on the law? Please understand, my dear friend. Law is saying that, okay, where you had losses or you have carried forward such losses or you have unabsorbed depreciation or you have MAT credit, AMT credit, and you are reducing them because you are filing ITRU for a year. Say you are filing ITRU for assessment year 21-22. So law is saying that for subsequent year also you have to furnish an updated return, and the term used here is shall. This shall does not fit to my understanding, because suppose for the assessment year 22-23, my time limit of regular filing is not expiring, then why should I file updated return for the subsequent year? I may be doing the necessary adjustment in my regular ITR even. But okay, let's say if we assume that for subsequent year also the time limit has expired, and then you want to do an updated return, you should be doing that, and it should be mandatory then. But another thing which would be coming there, that in a subsequent year where you will give impact to such loss, where you will give impact to reduction of such MAT credit, AMT credit, unabsorbed depreciation, then you should be ready to pay the additional tax liability in those years also. And if it is so, then in the fourth proviso, the example which I put up before you, that my 50 lakh rupees losses are reduced to 20 lakh rupees, it is still not a return of income. Why not my ITRU should be accepted? because it may be that in a subsequent year, against 70 lakh rupees income, I first adjusted 50 lakh rupees losses. But because of this ITRU filing for the first year, I am then supposed to reduce 70 lakh rupees rather than minus 50, minus 20. So I'll be paying additional tax liability on the remaining amount. So I should be first allowed to file the ITRU for the year one, and then I should be allowed to do the ITRU for the subsequent year. That is my understanding. See why I am putting up all these things before you, that while you will take up the charge of ITRU, all these questions are bound to come before you, my dear friends. And this discussion you may find probably useful at that level. Now, let me also discuss with you, Jitendra ji, I am not discussing any queries here. If the members want, we can discuss here also, or we may do it that first, let's complete the concept as per law, which I am trying to put up, and then we may take up the queries on updated return first, then we will take up 194R related thing. You
Okay,
can.
so members should post queries in the chat box only. Anoop ji will take up after the discussions.
I hope there is no objection on that. And if somebody wishes to ask me in between, they can tell me. So my dear friends, I go further in terms of discussing what is the tax on updated return, a very important concept. And in this regard, a deliberate new section is further introduced by the Finance Act 2022, which is 140B. And you all remember 140A, to which we call self-assessment. This 140B is having a title, tax on updated return. And it envisages two situations. Number one, where you have not filed a return earlier. And number two, where you have previously filed a return and now you are taking up a ITRU thing. So let me discuss that what is written in section 140B. 140B says where no return of income under subsection 1 or 4 or 139 has been furnished by an assessee and tax is payable on the basis of return to be furnished by such assessee under subsection 8A of 139 after taking into account. This is important, sir. That 139 8A would also give you a credit of that whatever is your final tax liability in 139 8A, the net payable will be determined after reducing. What will be reduced? Amount of tax, if any, already paid as advance tax, any tax deducted or collected at source, any relief of tax claimed under section 89, any relief or deduction of tax claimed under section 90 or 91 on account of tax paid in a country outside India, any relief of tax claimed under section 90 on account of tax paid in a specified territory outside India, and any tax credit claimed to be set off in accordance with provisions of 115JAA or 115JD. So all these reductions which we claim as on date in filing a regular ITR would be also available against an ITRU. And the assessee shall be liable to pay such tax together with interest and fee payable under any of the provisions of this Act for any delay in furnishing the return or any default or delay in payment of tax, advance tax, along with the payment of additional income tax computed in accordance with subsection 3. Here comes the chargeability. Additional income tax before furnishing the return, and you can't do it after furnishing the return. Your ITRU would be entertained. First, you pay your additional tax before furnishing the return, and tax shall be accompanied, and the return shall be accompanied by the proof of payment of such tax, additional income tax, interest and fees. A very, very important understanding, sir, that you are liable to file the ITRU if you think of doing so by way of first paying the additional tax, normal tax, any fees which is payable by you as well as interest. And all this process has to be completed before you are furnishing ITRU. And not only that, government is not satisfied with that. It is saying that you have to accompany the proof of payment of such tax and additional tax and interest and fees along with such ITRU. Now let me put up ITRU related subsection 2 thing before you. Now what this ITRU is saying, sir? ITRU subsection 2 says that where you have already furnished a return and now you are thinking of 139.8A, then what credits you can take after taking into account amount of relief or tax referred to in subsection 1 of section 140A, the credit for which has been taken in the earlier return. So in the first return, if I assume that assessee has already filed a return, in that return, assessee has claimed TDS credit, EMT, or advance tax. All those credit would be available in an ITRU also. And what else will be available? Tax deducted or collected at source in accordance with provisions of Chapter 17B on any income which is subject to such deduction or collection and which is taken into account in computing total income and which has not been included in earlier return. Sometime what may have happened that an assessee has filed a return and at that time he could not see that there was some TDS related entry appearing in form 26S. Later, when the time limit of revising the return has already expired or belated return has expired, he or she could find out that there is some form 26S TDS entry appearing there. And such assessee wants to claim the credit of the same because he is wishing to offer such income in ITRU. There is no barring by the law that you can't claim credit of such particular TDS TCS credit, 90/90 relief or 90A relief or MAT credit or AMT credit as the case may be. Here the law is assuming that in the earlier return you did not include such income and now because you are including such income in the ITRU, then you are entitled to avail such benefit even. Again, all these things will be increased by the amount of refund, if any, issued in respect of such earlier return. Very important point, sir. Before you file ITRU, assuming that previously you had filed a return which is 139(1) or 4, and in that return you claimed a refund which has already been returned to you. Then, while paying the additional tax at the time of ITRU, the amount of refund which you have already claimed would also be reduced in computing final tax liability. And reduce rather increase. And sir, suppose if the refund you have claimed has increased, then what will happen, Jitendraji? Suppose I claimed a refund of rupees 1 lakh in my ITR. And today I am filing ITRU wherein I admitted a tax liability of rupees 2 lakh and extra, which is without additional tax, and 1 lakh I've already claimed. So in that scenario, it may be possible that 1 lakh which I have claimed as refund and 2 lakh is over and above that I am supposed to pay. So 3 lakh is my balance tax which is payable. And on this 3 lakh, the additional tax liability would be payable, not on the 2 lakh rupees which is there on my ITRU. So this is one important point. The assessee shall be liable to pay such tax together with interest payable under provision of this act. This language is same, that you have to pay such tax along with interest and fees before uploading your ITRU. Now, how this additional income tax is calculating, that is to an extent, some of you may say, Bhatia, this is ridiculous. My opinion, it is ridiculous, or in the history of taxation, we all must be seeing this kind of interpretation for the first time. Please see this very carefully, that how would this additional income tax be calculated for the purpose of subsection 1 and 2, what is the quantum of that? The additional income tax payable at the time of furnishing the return under subsection 8A of 139 shall be equal to 25% of aggregate of tax and interest payable. Why did I say or use the term ridiculous, sir? Please understand, sir, till date we have been paying interest on tax. This is first time you are paying tax on interest. Government is saying 25% not of tax, 25% of tax and interest both. So say for an example, you have short paid 1 lakh. Till you are going to file ITRU, you are supposed to pay interest of rupees 20,000, which is compensatory interest, my dear friends. Please understand, interest under 234 ABC are not penal. That is compensatory. Section 220 interest is penal, my dear friends. But government is saying, okay, even if interest is compensatory, Bhatia ji, you are supposed to pay 1 lakh as tax, say in ITRU, 20,000 as interest. So total becomes 1,20,000. Of this amount, you will pay 20% or 50%. So tax being calculated on the interest. Till date, we have learned interest calculated on the tax, but this is on the reverse side. Whatever it is there before you. But this also gives us a sense that suppose interest under section 234 ABC is to be calculated because you delayed your return, you did not file your return. Then first what will happen? You will calculate the original tax which is payable. Then you will calculate the interest, which is a running meter, and most probably 234B is a running meter. You all would agree with me that 234B is a running meter. That running meter is there. That running meter is of 1%. And then 1% is further enhanced by 25%. So 1% becomes 1.25%. And for returns beyond 12 months from the end of assessment year up to 24 months from the end of assessment year, this becomes 1.5%, because the rates used are 25% and 50% respectively. I am not saying that we can't do so and we should do this, we should not, because this is the law I am trying to put up, my dear friends, before you. And if it is law, either it could be challenged or it has to be accepted and applied. So this is the theory of ITRU, which I have tried to put up before you, that okay, how this ITRU is demanding us 25%, 50% amount, and where it is technically wrong. But since it is a law which is approved by the parliament, prima facie it can be accepted, unless it is objected before Honorable Supreme Court and they say that this is invalid. Probably forums that these CPE study circles could also raise these kind of points at a larger level. I move ahead. Further, sir, I would simply like to put up that because 234 ABC implications are there, they would run along with ITRU. This is just an explanation which I tried to put up. And I would also like to highlight in reference to the tax liability payment for ITRU that there is an amendment made in 139(9) in the explanation thereof, which says that under certain cases, the return will be treated to be defective, and a clause CA is specifically inserted saying that the return is accompanied by the proof of payment of tax required under 140B if the return of income is a return furnished under subsection 8A, meaning thereby that if you don't pay the additional tax liability and you simply want to upload your ITRU, your return will be treated to be defective, which may be further treated to be invalid. Now, a question came into my mind, Jitendra ji, that can we file ITRU for the assessment year 2021 and assessment year 21-22, because the law is in force from the Finance Act 2022, meaning thereby that ITRU option should be available from assessment year 22-23, say 23-24 onwards. This is what I was trying to understand. But when I went into this question, I could refer to a Rule 12 AC, which is deliberately inserted in ITRU concept, which says the return of income to be furnished by any person eligible to file return under subsection 8A of 139 relating to the assessment year commencing on 1st day of April 2020 and subsequent assessment year shall be informed ITRU and be verified in the manner indicated therein. Mind you, my dear friends, this is a very clear mandate by the Government of India by way of inserting Rule 12 AC that you can even file ITRU for assessment year 2021. I can say onwards, because 2021, 21, 22 are those which are in our domain as on date. 2021, 12 months from the end of assessment year have expired, but 24 months have not expired. So additional tax liability would be 50%. And 21, 22, 12 months from the end of 11th assessment year has not even expired. So you will be going with that with 25% of additional tax payable on the tax and interest amount. And again, sir, this 25% or 50% is on tax and interest, not on the fees. But fees would be payable where you did not file a return at all. Or Jitendraji, it can also happen that ITRU was filed, original ITR was filed, say with 1,000 rupees fee. Later, because you enhance your income, you may fall into 234F 10,000 rupees criteria for assessment year 2021. That could also be one case which may arise before you. Further, my dear friends, 12 AC Rule 2, it provides that when you are filing this ITRU, if you are liable for audit, it should be digitally signed. And if you are not liable for audit, it can be digitally signed or through e-verification also, it can be filed. Now, let me discuss with you this form ITRU, which is notified by notification number 48/2022, dated 30th of April 2022. Please see this form carefully. This form is titled as ITRU only. Indian Income Tax Updated Return for persons to update income within 24 months from the end of 11th assessment year. Your PAN, your name, your Aadhaar details would be there. Then the type of assessee, whether you have earlier filed a return, whether it was filed in 139(1) or otherwise. And if you have earlier filed a return, its acknowledgement number. Are you eligible for filing an updated return as per list laid out in 1st, 2nd, 3rd proviso to 139(8A)? This form is clearly asking you that have you checked your eligibility? Naturally, if you will say no, then your ITRU cannot be entertained. Please choose the ITR form for updating your income. ITR 1 to 7 to be selected from drop down and filed as per details made available by e-filing utility. Please understand, sir, I discussed this question but did not answer this. And now I am answering this. While you are uploading ITRU, assuming that you did not originally file the return, you are also supposed to upload your ITR 1 to 7 form, whichever is applicable to you, in my opinion. And what will happen to a case where a person has already filed an ITR and now he or she is uploading ITRU, whether in such case also ITR 1 to 7 should be uploaded? In my opinion, it should be allowed. But whether it is practically allowed or not, that I'll discuss. That I cannot discuss as on date, because the online filing facility is not fully operational even as on date. And some clients of yours may be asking that, sir, I want to file ITRU. Moment you go online, you can't find that it is fully operational as on date. And please understand, sir, when CBDT notified this ITRU form, it referred that C instruction, that there are certain instructions which should be annexed to this form, but I could not find any instruction. Now you see this last portion, 8, reason for updating your income. You have to pick up one of these reasons. Why you are doing ITRU? Because you did not file your ITR previously, income not reported correctly, wrong heads of income chosen, reduction of carried forward losses, reduction of unabsorbed depreciation, reduction of tax credit under 115 JBJC, wrong rate of tax or other. You have to pick one of these reasons. Further, this form asks you, are you filing updated return during the period up to 12 months or beyond 12 months up to 24 months? Because this will help them to determine what is the additional tax liability payable from your side. Are you filing the updated return to reduce carried forward loss or unabsorbed depreciation? Say yes or no. If yes, please specify the assessment year where carried forward loss or unabsorbed depreciation or tax credit being affected because of this updated return. Whether revised return has been filed for the assessment year in B above, yes or no, and whether updated return has been filed. Please get this point from here. I said that if the time limit for revised return for subsequent year has not expired or original return has not expired, that should be allowed rather than asking me or forcing me to file an updated return. I hope I am there. Then, sir, there is a computation portion also you can find in ITRU, ATI computation of total updated income and tax payable. Here it is asking you that, okay, head of income under which additional income, your only additional income you need to mention here. Head of income, if yes, please specify additional income, income from salary, house property, business profession, capital gain, other source. Total additional income would come here. Total income as per last valid return if you have filed. Total income as per Part B TI, and amount payable, if any, to be taken from amount payable as per TTI. So you need to fill up all these details to complete your ITRU. All these details are further carried on. Amount refundable to you. See, when the form is giving amount refundable, it means, see, please see it in this context. I am first reading last point 3, amount payable, if any, to be taken from amount payable of Part B TTI of the updated return, and amount refundable. So through an updated return also, there is a possibility of refund, whereas the proviso is denying the refund. So this is a practical thing. Law is saying you can't claim a refund. Form is saying whether you have amount refundable out of even after this. So this thing has to be practically solved once we will be uploading the return. Practically, it could be seen. Conceptually, you can't claim a refund through ITR. Then amount payable on the basis of last valid return, refund claim as per last valid return, total refund issued as per last valid return, fees for default in furnishing 234F, regular assessment tax, aggregate liability on additional tax, in case where refund is issued and in case where refund is not issued, additional income tax may be 25 or 50, net payable by you. Now here the ultimate answer is net payable. Tax paid under 140B, final tax due. If you are saying final tax due, probably your return may not be accepted. Then if you have made the tax payment, the BSR code, details, etc., challan details are to be provided. Any tax credit which you are claiming, of advanced tax, self-assessment tax, etc. to be mentioned. And finally, the verification to be done by. So I would like to summarize that this ITRU filling is mandatory. When you are thinking of ITRU, it should be along with the ITR form, which is usually applicable to you. How it practically happens, I can't give you that clue as on date, because this functionality is not fully operational as on date yet. Now, I may like to put up an example before you. Please see this carefully. Here I am trying to say that I have taken an example of a partnership firm to which I named X and Company. Suppose it has filed an original return with 10 lakh rupees income and tax payable by it was 3 lakh. Marginal tax means the tax which was payable at the time of this return, say 3 lakh. Additional tax, no, because original ITR I am assuming 139(1) or 4. 234A, if it was a belated return, that would be payable. 234B, if on the part of assessee there was short payment of advance tax, would be payable. And if there were deferment, 234C would be payable. Whether any penalty under 270A would be payable, answer is nil. Suppose this firm revises it to 12 lakh total income. Then total tax liability will be 360. And what will happen in this case? The additional tax would be 60,000. But even you are doing revised return, there is no additional tax payable, yet 234 ABC may follow and 270A would not follow. Now you come to this updated return. Say the firm has further increased its income in updated return to 15 lakh from 12 lakh. Then how much additional income, sir? 3 lakh. Total tax payable on 15, let's assume 4,50,000. Now what is marginal tax? 90,000. Now this marginal tax 90,000 is 4,50,000 minus 360. So this 90,000 would attract additional tax of 25% to 50%. That too not only tax amount, but on the tax plus interest amount. And whether 234 ABC would apply, if this return, which was first return, was belated return, that is original return, then assessee would be liable to pay 234A interest, because 234A liability would increase at the time of filing an updated return. However, 234B would also change, 234C would also change, because assessee is himself increasing his income in updated return, yet 270A would not apply. Now let's assume an extreme case that an assessment also gets opened in this case and the final income determined is 20 lakh. Then the marginal tax over and above what he has already paid would be 1,50,000. Whether any additional tax would be payable at the time of assessment, my answer is a very clear no, because assessee is not accepting, it is department who is assessing here. 234AB may follow, C would not change here, but 270A would attract here. So I hope this example could give you a clarity on that, okay, how the ITRU is going to have an impact at different stages, or how the different stages would have an impact on the assessee in terms of additional tax or normal tax or interest, etc. Now let me quickly discuss with you online filing snapshots, which I could trace for your reference. Say I went to my online filing utility or portal. I went to e-filing, I clicked that income tax return, I went into file income tax return. Then I got an option that I have to select, say I wanted to do it ITRU for assessment year 21-22. I selected 139.8A. Are you audited? Say I said no. Which ITR I am going to do ITRU is ITR 3. Moment I clicked there, I got a second, I proceeded further. I got a second snapshot. File income tax return under 139.8A for 21-22, upload. It is not giving me option to file it here. It is asking me that you attach a file. Which file, sir? This ITRU form, which is to be prepared separately. You read this information. Upload your filled ITR form prepared using the offline utility. If you want to download offline utility for filing income tax return, please click here and you will be redirected to download. So I downloaded this utility also, my dear friend, and this is the utility snapshot. This is not portal snapshot, utility which I could open, and you can see this utility is presently showing ITR 1 to 4 because I am an individual and forms applicable to me would be between ITR 1 to ITR 4. So when I clicked here, file returns, I move further. Here I have to select download pre-filled data or import pre-filled data. Say I downloaded JSON file from my previous return which I filed. and I clicked here import pre-filled data and said submit. Then it took me to the second window wherein it asked me my PAN and it is asking me to select assessment year. Here I got surprised because it is not allowing me to select assessment year 21-22. The list is complete. Whereas I am wishing to do it for ITR U for assessment year 21-22. So practically to show you, I could not reach out to the right level. And that is why I cannot go beyond this. I could not go beyond this to discuss with you that how this ITRU being filed online. Before I conclude this ITRU related discussion, sir, I had few aspects in my mind that whether filing of nil ITRU is possible, yes or no. In my opinion, conceptually speaking, a person should not be barred even if he or she is filing a return up to rupees 5 lakh, being an individual who is resident in India, not liable to pay final tax liability, since they are doing it beyond 139(4) time limit or 139(1) time limit. Say I pay a challan of rupees 1000 under 234F. Whether in that case my ITRU may be admitted? Answer to this question should be yes. But practically would it happen or not? That I can decide only after this ITRU utility is fully functional. Tax audit and ITRU. Suppose you are filing ITRU for a person in whose case tax audit has already been conducted. Now a question may come, Jitendra ji, do we need to revise the tax audit? Suppose the income pertains to business. That is also an important thing. And then in that case, would you also like to revise your P&L and balance sheet? And suppose if you don't revise your P&L and balance sheet which you have audited, and the person is wishing to offer extra income in PGBP, what will happen to your audit report? ITRU vis-a-vis 143(1). This I have already explained to you that even after 143(1) an ITRU can be done. And I am of the mind that ITRU would also be subject to 143. ITRU vis-a-vis section 12A subsection 1 clause BA. What is this? This section 12A is very important, which says that if you want to claim the benefit of 11 and 12, your return should be filed in time as a charitable trust or religious trust. Now, suppose I missed to file the return and as a trust, I am wishing to file ITRU to claim the benefit of section 11 and 12. Probably, in my opinion, that would not be available. Similarly, 80AC, mind you, my dear friends, is a very important section which says that chapter 6A part C deduction, 80IA, IAB, IA, IC, etc. can't be claimed where you did not file the return in time. Suppose I am ready to file ITRU. Can I claim 80AC? Can I claim chapter 6A part C? My prima facie answer is no. But suppose in original ITR, which I filed, I claim chapter 6A deduction, clause C. Say I claim 80IA or 80IAB, etc. And through this updated return, I want to enhance my deduction. In my opinion, sir, till I am going to pay the updated return related additional tax, there should not be any problem to the government in myself increasing my deduction. This is my conceptual understanding. But these are the things which I have to test while this online utility would be fully available. So before I start my discussion on 194R, this was my discussion on ITRU. Jitendra ji, if any questions up to ITRU level, we can discuss it here also. As is convenient
Mr.
to
Nitin Kothari raised the hand.
Right, sir.
Mr. Nitin.
Hello.
Yes, Nitin ji, namaskar.
Yeah, namaste, sir. Just actually, I have joined slightly late. I just want to know, like one
Okay.
simple query, that in the circular say ITRU, but the income tax online, they say ITR 1, 2, 3, 4.
Right.
So like, I want to know whether we have to file ITRU or ITR 1, 2, 3, because ITRU there's nothing the ITRU in the online website.
Right. Nitin ji, I show you this particular thing. See, when I went to online, even I was trying yesterday so that I can bring in the best to the members at large. And you can see that what happened here, that in my login, when I went into income tax return, I opted for file income tax return. Then it took me to the second window. It asked me to select the assessment year. Then it allowed me to select from various options that do I want to file updated return? It allowed me. audited, non-audited, I selected that ITR 3 is applicable to me. Then when I came into 139.8A, it said that you have to simply upload. Now, which return I'm going to upload? They are saying upload your filled ITR form here. Which ITR form? In my opinion, it should be ITRU. I can't see that form here. So what I did, I clicked here to download the utility also. When I download the utility, this utility you see on the top, desktop utility ITR 124, income tax return ITR 124. So your question is very valid. It is saying that, okay, which form I'm going to upload? Am I going to upload ITR 1, 2, 3, 4, or I am going to upload ITRU? I have discussed with you ITRU form also. So one clue is very clear from that naturally you are supposed to upload ITRU form, because if that form is not required to be uploaded, why it has been notified? So ITRU is supposed to be uploaded. What I am trying to add from my side, in my opinion, the form which you will upload ITRU, suppose you did not file a return earlier, and ITR form applicable to you is say ITR 2 or ITR 3. Without filling that form online, without allowing you to fill that form online, how would government know that what are your deduction of Chapter 6A? What is your income under respective head? Are you claiming any particular rebate relief? What is that? So a combination of these two should be allowed. But practically, I am very clearly admitting that even till date, I could not file an ITRU because of this online functionality not functional. So my understanding to that question is that yes, we need to upload ITRU form. And if I previously did not file, then in that case, the respective form applicable to me should be allowed. And some of you may also say that, no, Mr. Bhatia, if you have already uploaded a form and now you are changing your income in ITRU, then the revised form, whichever is applicable to you, should also be allowed to be filed. But without original functionality applicable here online, I can't comment specifically. This is my answer.
Another question from Anjali.
Yes, Anjali ji, namaskar.
Anjali Ghatkar.
हेलो हेलो
Yes,
सर
Anjali.
गुड मॉर्निंग
good
आपने सब एक्सप्लेन किया बट थोड़ा अभी भी कंफ्यूजन क्या हो रहा है कि इन वन ऑफ माय क्लाइंट केस वी हैव फाइल ओरिजिनल रिटर्न एंड दैट टू विदाउट क्लेमिंग एनी टीडीएस और समथिंग लाइक दैट और कैपिटल गेन भी डिस्क्लोज नहीं किया तो प्रोबेबली ही मस्ट बी हैविंग रिफंड आफ्टर फाइलिंग द रिवाइज रिटर्न और 139 न्यू रिटर्न रिफंड ऑफ अराउंड 40-50,000 आई गेस से तो अभी हम लोग फाइल कर सकते हैं क्या बाय डिस्क्लोजिंग ऑल द डिटेल्स करेक्टली ओरिजिनल रिटर्न नील फाइल किया है आई गेस खाली सैलरी कुछ दिखाया होगा.
Okay. Anjali ji, my clear opinion is, suppose your total TDS or your advance tax or self-assessment tax which you have earlier paid is on a higher side to the tax liability which will be along with the additional tax. Say, with the additional tax, your tax comes to 37,000. Okay. And the total advance tax or TDS appearing in your return is 50,000.
Okay.
So in my opinion, I don't see any problem that you can't claim the refund. You can claim the refund. You should be allowed to do so because you have paid the additional tax to the government. Suppose
बराबर पहले नील फाइल किया अभी 37,000 का लाइबिलिटी आ रहा है you mean to say हाँ.
Yes.
Okay.
And
Okay.
your total TDS is say 50,000, then you are claiming 13,000 refund, then why not? This should be allowed.
Yes.
This is my understanding.
Okay. Fine. Thanks.
Welcome.
But अभी AY 21-22 का जा नहीं रहा है ना आप बोल रहे हैं कि
I can't find out if somebody of you from you could do that, then I'll be happy to listen from them.
Yeah, sir. That Winman, the software which we are using, that Winman is going to update from 11 July. They were saying on their updations. So let's see कि 11 July को वो होने वाला है क्या update? हाँ. 11 जुलाई को अगर होता है तो फिर आई गेस वो समझेगा कि हो रहा है कि नहीं हो रहा है. हाँ. तो I will update you surely, sir, on your ID.
Thank you.
Yeah. Thanks.
Another Nitin Kothari again.
Yes, Nitin.
Nitin ji.
Hello. Yeah, actually,
Yes,
I am not able to unmute myself. Now I able to unmute. So regarding this ITR filing, what I seen that in the download section, there's a Excel. They have in every ITR they have given Excel utility Excel based for
Right.
updated return. Like ITR 1, ITR 2, they have given utility Excel based.
Okay.
So what is my understanding that we have to file that Excel based utility, like and then we can upload that ITR. Suppose I have ITR 2 applicable for capital gain, like whatever then I have to file ITR 2 and then I have to upload it. So I think there is no ITR U is there. This is only in the notification, but it is practically it is not there ITR U.
I can only answer Nitinji once I am actually able to do it online, since it has not allowed me to do. So
No,
therefore,
it is allowing now.
it is allowing,
No, yeah, you can see if you go in the download sector.
right?
In the download, they have given the Excel based utility for updated return.
Okay. No, I'm not saying that it is not allowing me to download, whether it is allowing me to upload or not.
Yesterday
Download, I
they
have
have,
also done all these forms and all these things. But moment you try to upload, it is not allowing you to upload. So that is where we stuck. So without doing that process completely single-handed, I'm not in a position to comment. This is what I'm saying. Once I'll be able to do so, probably if this session would have been after that facility were available, I would have been in a better position to comment upon.
So what I think that this what is my general thing is that ITRU they have notified, but actually it is not practically they have done anything for ITRU.
You are right. You are right, and they are very delayed in that. They are very delayed because people are asking us as a professional. People are asking us, "I want to do ITRU." Then when we think of that, okay, let me think of ITRU. I have to first answer why. You can say, Anoopji, in beginning you said nobody came to you. People did not turn up to me in terms of my client, but people wrote to me on ITR, my YouTube channel, saying that, okay, Mr. Bhatia, we are thinking of filing ITRU. When can we do so? Tell me the date. I'm not the person to specify the date. Government should come up with the full functionality and we will be able to report then only.
Utility has come. Option to upload has come, but I don't think so. You can actually
It's
upload.
not functional, Aditya. You are right.
Yeah.
Yeah.
We are waiting for that.
One more
Yes,
thing.
Nitin.
Just suppose if any person who has filed the return and got the assessment order and got the refund. Now, if you want to show further income of long-term capital gains which he has forget, like most of the people, most of the problem, most of the cases is that the people has forget to show the capital gain. Those who are filing themselves now. So
Yes.
now, if they already got the refund, now if we can file again ITR, this assessment order is issued that.
Yes, Nitinji, I have very clearly spoken that even if 143.1 is issued, there is no doubt, there is no objection that assessee can't do ITRU because it is not completion of an assessment. It is simply an intimation. And if it is an intimation, where can we say that an assessment is completed? Yeah, it is a different thing that people at large think that, okay, they receive 143.1, it means they have been assessed. It is not at all an assessment. It is just processing of the return.
Okay.
So it can be done.
Okay.
Another question from Vaibhav Sakla ji. Income below taxable limit, hence normal ITR file not filed. Can now return be updated? Now also the income below taxable limit. So I think
I have tried to answer this during the course of discussion only, that I am of the mind that conceptually speaking, government should not prevent me by filing such kind of return that I'm using this window, because I'm at least declaring to them, I'm giving information to them that this is the kind of income in my hands. But they want me to come by way of paying additional tax liability. Now, suppose additional tax liability payable is nil, and they are asking me to upload that particular challan. I don't know whether practically that challan could be uploaded that way. It should be appearing in 26 years. I have to simply give the BSR detail in ITRU, which I am giving. So practically, whether it will be possible or not, without filing a return, I can't comment. Theoretically, I am saying, yes, such kind of return should be accepted. But if you see the objectives of the government, they have the measure of collecting additional tax liability with reference to ITRU. So they will say that you are not an eligible candidate because you are not ready to pay. Suppose I am saying, okay, let me pay 234F, 1,000 rupees, 5,000 rupees, and then admit my return. And just I am trying to make them fool, okay, I have at least paid some amount. That is additional tax. You admit my return. This thing has to be practically seen. It may be, it may not be. Higher are the chances, in my opinion, it may not be entertained by.
Not the late fees. You are talking that the tax and interest should be 25%.
Yes, because that is a must. Suppose, Jitendraji, if we don't pay that, then what will happen? Then would they accept my ITRU? Prima facie answer is no, because they wanting me to pay the additional tax liability, and additional tax liability payable by such person is nil. One case may arise here. I tell you where. Suppose we by default assume between 2.5 lakh to 5 lakh rupees, the tax payable is generally at 5%. But suppose between 2.5 to 5, you have LTCG of 10% or 20%, or you have STCG of 15%. And in that case, even after claiming the rebate of 87A, you have net tax payable. Then in that case, such return should be accepted, because there the net tax payable is coming, and net tax payable would be enhanced by the additional tax liability, further appended by the additional tax and interest and fees, and then that return should be accepted. But what will be with those, Jitendraji? Suppose if somebody is filing a return with 2 lakh rupees income as ITRU, who is not even liable to pay a fee of rupees 1,000 under 234F. Do we think that such kind of return may be admitted under 234F? Prima facie, there is no sense of working on such return, in my opinion. And secondly, if somebody technically asks me, I will say, sir, you should not be allowed because you are not ready to pay at all to the government. Am I right, Aditya ji, in your opinion?
Agree.
So I'm also trying to learn with this discussion. I can't say that I am the final authority. I'm also trying to learn.
So that's why it's a discussion, sir.
Yes, sir.
So in one of my client case, we had shown income not credited to P&L in case of an individual, like dividend income and capital gains, as reported in tax audit report, and it got captured in ITR also. So now we have got an intimation 143(1)(a) we had replied that this is already income has been shown. There's no double addition possible. But then now they have added and got the intimation. So we can file ITR just removing that thing, or we should go for rectification.
In my opinion, it is a matter of rectification, sir.
Correct.
Suppose even if you admit it, would you like to pay, since you have already included those income into ITR? And mind you, what is happening, sir, that naturally CPC is working on the software basis. They are not allowing any manual intervention. So somebody who was writing that software, he simply gave the instruction to the software. If auditor objected or auditor said that there are certain income not credited to the P&L, raise a demand without looking into whether in the ITR similar amounts are reported under the respective heads or not. Now, this is a matter of mistake apparent from record. They should go into rectification, in my opinion. There is no ITR. Why will we suggest the assessee to pay the additional tax on such income which he has already paid?
Assessee has said that just increase 10 rupees my interest income also says, file, you just need an additional tax, 10 rupees बढ़ा दो, tax आ जाएगा.
So that is a jugaad. If it is allowed, let's use it.
In one of our case, we have reported the contingent liability in the tax audit report, and he added as a contingent liability.
Okay.
So if you have debited to P&L, you have to report. If not debited, then
contingent liability, it is just a disclosure.
No. Tax audit report clause is if debited, then you have to disclose.
But Jitendraji, you are saying that you mentioned into contingent liability and they picked up for addition.
Yes.
From tax audit report.
It means that it is not system based. It is somebody who is manually looking into your report and picking up that contingent liability. I can't understand this because there is no reporting criteria of contingent liability as such specifically. Is it there in tax audit report?
Tax audit report is there only if it is debited to P&L. You have to report. not otherwise.
So we can rectify tax audit report or
You'll have to revise. You'll have to revise.
Yes, yes. Ideally,
tax
we
audit
should.
report.
That is also one way, Jitendra ji, you are right. Just like in the case of Aditya ji, we first rectify our. Ideally, it should not be required. But suppose if it is so that we have to give the relief, we have to claim the relief for the assessee. In tax audit, I remove those points, and then I ask for reprocessing of the return. Probably this kind of issue may get resolved.
My case that got captured in ITR also, so that is why it is coming. I think earlier it never came. We got a notice 143 1A and one line the rebuttal has been done in the intimation. Notice was sent, not found appropriate or not replied. That's the one single line, and they have gone for hired for addition.
Nowadays, Aditya ji, within 15 minutes, you will receive a rectification order denying the rectification. So fast they are.
Correct.
I don't know what they are doing. So, should I proceed further,
Yes.
Jitendra ji?
Yes, I don't think
Yes,
there
sir.
is
No further
a question. Yeah.
Now, my dear friends, I take you to the provisions of 194R, which you all must be waiting for us to discuss because it is even more important than ITRU. See, background for 194R, you all know, is section 28, clause 4, that is PGBP, profits and gain of business or profession. Section 28, relevant point, I am trying to put up this clause 4. The following income shall be chargeable to income tax under the head PGBP. Clause 4, the value of any benefit or perquisite, whether convertible into money or not, arising from business or exercise of a profession. Very, very important point, sir. This is the whole background of 194R. And too much of disputes, too much of compliances are going to arise before we as a chartered accountant, practicing chartered accountant also, people, companies would start asking you, sir, how to give effect to 194R, when 194R is applicable, when not applicable. And one of the main criteria of 194R or the background material is 28 clause 4. And why 194R is there, and you all would agree with me that, sir, TDS is one criteria or one area where every year you receive 3-4 amendments, rather 2-3 insertions of new section. And TDS makes government's job easy because it creates a loop. It's a kind of complaint or providing of information of one person by another person that, look, this person has this income. Now you see whether he offers in his return or not. And as from our experience, we can see maybe AIS or maybe 26S, all are moving the assessee towards the self-compliance because of these reporting by the deductors only. And 28 clause 4 is one more nail to the part of the assessee from the payer side. Now see, 28 clause 4, largely you all would agree, was not reported mainly by the assessees in their return, or was even not largely on the radar of chartered accountants, even if it was mentioned in tax audit report. But this 194R would make the whole system operational at one go, because it says that PGBP would include value of any benefit or perquisite, whether convertible into money or not. See, what is most ununderstandable thing to me, you see the scope of the law, which says whether convertible into money. Now, what is not convertible into money would fail on the quantification criteria. How can it be taxed? But government has made up its mind very clear from the date of insertion. And please note, sir, 28 clause 4 was inserted way back in the law by the Finance Act 1964 with effect from 1st of April 1964. So it's not a new insertion. 28 clause 4 was prevailing since 1st of April 1964. It is a different thing that TDS section has come up after so many years. You can say more than about 59 years. So see, when this is the background, and I try to go into the memorandum of the Finance Bill 2022, the background material said TDS on benefit or perquisite of a business or profession, because government felt that this is the area 28 clause 4 goes without tax. So let it be taxed. And the responsibility of taxing it is casted on the shoulders of the payer. TDS on benefit or perquisite of a business or profession, as per clause 4 of section 28 of the Act, the value of any benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession, is to be charged as business income in the hands of recipient of such benefit or perquisite. However, in many cases, such recipient does not report the receipt of benefit in their return of income, leading to furnishing of inaccurate particular of income. So, Aditya ji, Jitendra ji, this is the reason, my dear friends, why 28 clause 4 is now in the better format of 194R. And further it is written, accordingly, in order to widen and deepen the tax base, it is proposed to insert a new section 194R to the Act to provide that the person responsible for providing to a resident any benefit or perquisite, whether convertible into money or not, arising from carrying out of business or exercise of profession. Please, sir, I invite your kind attention again. Arising from carrying out of a business or exercise of a profession by such resident. So 28 clause 4 is applicable when the recipient of such benefit or perquisite is into a business or profession. Say, for an example, a chartered accountant in practice conducted an internal audit. The company was so happy with his work, company offered him a Honda City car, say of rupees 15 lakh rupees. Now, this 15 lakh rupees car is taxable in the hands of such particular chartered accountant, not as a gift, but as business profession income. And now this company who is giving such Honda City car to the chartered accountant would be deducting tax at source, meaning thereby that such CA would be required to report that 15 lakh rupees as his professional income. Now, this may also attract GST consequences, which I am not an expert, so I will not touch upon there. Shall, before providing such benefit or perquisite, as the case may be, to such resident, ensure, and mind you, sir, this section is for resident, because for non-resident 195 was already applicable. To such resident, ensure that tax has been deducted in respect of such benefit or perquisite at the rate 10% of the value or aggregate of value of such benefit or perquisite. And for the purpose of this section, the expression person responsible for providing has been proposed to mean a person providing such benefit or perquisite, or in the case of company, the company itself, including principal officer thereof. So, sir, this is background material from Finance Bill. Now, let me discuss 194R. Inserted by Finance Act 2022 with effect from 1st of July 2022, meaning thereby from 1st of April 2022 to 30th of June 2022, section was not operative. Deduction of tax on benefit or perquisite in respect of business or profession. Any person responsible for providing to a resident any benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession. Sir, please understand this language. I would like to repeat again before you. Arising from business or exercise of a profession. So for recipient, such amount, such benefit should arise from business or profession. By such resident shall, before providing such benefit or perquisite, as the case may be, to such resident, ensure that tax has been deducted in respect of such benefit or perquisite at the rate 10% of the value or aggregate of value of such benefit or perquisite. So 10% is TDS rate. When TDS is applicable, it is applicable at the time of providing to a resident. When you are providing, because usually in TDS we understand TDS section is applicable at the time of payment or credit, whichever is earlier. This is not payment or credit, whichever is earlier. It is applicable before providing such benefit or perquisite. So unless you provide, 194R does not come into picture. I give you an example. Say, for an example, the company has spent certain amount on such kind of a scheme under which it has gathered certain materials, say ACs for distribution to the dealers. But it has incurred expense, it has not yet distributed. Only by way of incurring expense for acquiring, purchasing ACs, the liability of 194R would not arise. 194R would arise immediately before providing such benefit or perquisite. Unless you provide, there would not be any TDS compulsion under 194R. Further, there are three provisions. Provided that in case where benefit or perquisite, as the case may be, is wholly in kind or partly in cash and partly in kind. But such part in cash is not sufficient to meet the liability of deduction of tax in respect of whole of such benefit or perquisite. The person responsible for providing such benefit or perquisite shall, before releasing the benefit or perquisite, ensure that tax required to be deducted has been paid in respect of such benefit or perquisite. See, in these kind of sections where the perquisite or benefit is involved, monetary value would be there, but monetary payment would not be there. The TDS is a complex issue. The government has said we are not worried about it, whether you provide in kind or you provide partly in cash or partly in kind. We require you to comply with TDS. Further, that the provisions of this section shall not apply in the case of a resident where the value or the aggregate of the value of benefit or perquisite provided or likely to be provided to such resident during the financial year does not exceed 20,000 rupees. So if it exceeds 20,000, then TDS would arise, otherwise would not. Meaning that if you are providing benefit to a person up to 20,000, no TDS. This is for financial year. Beyond that, TDS would apply. Further, provided that the provisions of this section shall not apply to a person being an individual or HF whose total sale, gross receipt or turnover does not exceed 1 crore rupees in the case of business or 50 lakh rupees in the case of profession during the financial year immediately preceding the financial year in which such benefit or perquisite as the case may be is provided by such person. What does it mean? It means that if your gross receipt or turnover as an individual or HUF in the preceding financial year was not exceeding into your business 1 crore or 50 lakh as the case may be, you are not liable for 194R compliance. Further, subsection 2 and 3 are made to make it operational that if any difficulty arises and CBDT gives any clarification, such guidelines will be put up before Parliament. Now, after understanding through the BEAR Act, I would like to invite your kind attention to this circular number 12/2022 dated 16th of June 2022, which contains 10 different questions answered by CBDT, which are very important to us. But before I move into that, sir, I would like to reiterate that CBDT circulars are not mandatory on the assessee, they are binding on the revenue. So this is not FAQ, yet it is FAQ. Means it is a circular. Circular is not mandatory on me. It is clarificatory. So I may object to a circular because there is too much dispute bound to arise on 194R. We will see few queries and through that I will try to raise up those points. So these key questions, which are 10 questions, which are answered here, I am trying to put up before you. First question, sir. Is it necessary that person providing benefit or perquisite needs to check if the amount is taxable under clause 4 of section 28 of the Act before deducting tax under section 194R of the Act? See, sir, as a businessman, X Limited is going to provide certain benefit or perquisite to A, B, C, D, etc. Whether X Limited is required to see that for A, B, C, D, such amount of income would be taxable under 28 clause 4. The recipient may claim, no, sir, it is not 28 clause 4 for me. It may be 41(1) or it may be other source income or it may not be taxable at all. And please see the answer of this question in the context of that background material which I read, and even in section it is written during the course of business profession, the recipient should be there. Now you see what is written in the circular. Question, is it necessary that person providing benefit or perquisite needs to check if the amount is taxable under 28(4) of the Act before deducting tax? Answer written, no. Law is saying the person who is receiving in the course of business provision. You are saying no, you need not to see. If you are giving benefit or perquisite, threshold is exceeded, you deduct TDS. No, deductor is not required to check whether the amount of benefit or perquisite that is providing would be taxable in the hands of recipient under clause 4 of section 28 of the Act. The amount could be taxable under any other section like 41, etc. 41(1), etc. Section 194R of the Act cast an obligation on the person responsible for providing any benefit or perquisite to a resident to deduct tax at the rate 10%. There is no further requirement to check whether the amount is taxable in the hands of recipient or under which section it is taxable. Sir, I am saying this circular is breaching the law. This circular is breaching the law in its question 1 itself, because it is saying that you need not to see that in the hands of the recipient whether the amount would be taxable and if taxable under which section. On a safer side, you would always suggest to your client, sir, you deduct tax at source. But sir, this section is not applied in the background in which it is inserted. And that is where we as chartered accountant tomorrow, if we go into such kind of appeals, would be able to fight this matter that this circular is not validly written. Okay, let me come to question number 2. Question number 2 says, is it necessary that benefit or perquisite must be in kind for 194R of the Act. So CBDT has very clearly said that, look, we have inserted a proviso wherein we have said that partly in cash, partly in kind, or cash is not sufficient, then still you ensure TDS. So CBDT is clear here that even if benefit or perquisite in cash, you deduct. Even if it is not in cash, you deduct. Both the side you have to deduct. Let's see question number 3. Is there any requirement to deduct tax under 194R of the Act when the benefit or perquisite is in form of capital asset? See, the recipient is receiving it as a capital asset. He or she is not receiving it as a business, because the recipient may say, look, the builder has allotted me a flat because I made him certain benefit. I am a professional. So what I received is a capital asset. So what I received is a capital asset. How can you take it into the provisions of 194R? CBDT has clarified, as has been stated in response to question number 1. There is no requirement to check whether the perquisite or benefit is taxable in the hands of recipient and the section under which it is taxable. So we are saying that, okay, government is saying, we want you to deduct TDS whether the recipient is receiving in the course of business provision, receiving it as a capital asset, or otherwise. Question number 4. This is very important, Jitendra ji. Whether sales discount, cash discount, and rebates are benefit or perquisite. Very, very important question, sir. Fortunately, it is answered positively. To this extent, it is beneficial to the assessee we would like to adopt. Sales discount, cash discount, or rebate allowed to customer from listed retail price represent lesser realization of the sale price itself. To that extent, purchase price of customer is also reduced. Logically, these are also the benefits through thou related to sales or purchase. Since TDS under 194R of the Act is applicable on all forms of benefit or perquisite, tax is required to be deducted. However, it is seen that subjecting these to tax deduction would put seller to difficulty. To remove such difficulty, it is clarified. Point to be noted, sir. It is clarified that no tax is required to be deducted under 194R of the Act on sales discount, cash discount, and rebate allowed to the customer. So CBDT very clearly mentioned that no TDS under 194R on sales discount, cash discount, and rebate allowed. But it further said, similarly, this relaxation should not be extended to the other benefit provided by the seller in connection with its sale. To illustrate, following are some of the example of benefit perquisite on which tax is required to be deducted under 194R, yet the list is not exhaustive, where a person gives incentive in the form of cash or kind, such as car, TV, computer, gold coin, mobile phone. When a person sponsors a trip of the recipient and his or relative upon achieving certain target, when a person provides free ticket for an event, and when a person gives medicine sample free to the medical practitioner. Very clear. Sir, when the pharma companies are distributing medical samples to the doctors, they are supposed to deduct tax at source. I again say it could be problematic for the doctors because MRs various time, medical representative, they go and meet the doctor and give him, sir, please, you may mention this particular medicine, and they give free samples to the doctor. Whether the doctor sells off those free samples, prima facie, no, either they keep it collected at their own, or sometime I have seen that doctors are giving such particular free samples to those who are needy or to those who are known to them. The question comes that whether such kind of free sample of medicine is a perquisite or benefit to a doctor. 28 clause 4 is wider enough to make it into taxation, and therefore 194R would be applicable. But a doctor may argue that if I'm trying to find out the feedback through the patient of this medicine's effect, I'm simply practicing, I'm not getting benefited directly through this medicine or its sample thereof. So this is a challenging thing, but on a safer side, TDS would be deducted. Question number 5. Fortunately, this circular is there, therefore I'm discussing all these queries before you, just for a quick reference, so that this session may prove to be beneficial to all of us, that okay, we have at least seen the circular, and now we have a mindset that what is the requirement from the side of CBDT. How is the valuation of benefit or perquisite required to be carried out? Very important question, sir. CBDT answered, valuation would be based on fair market value of benefit perquisite, except in following cases. The benefit perquisite provider has purchased the benefit perquisite before providing it to the recipient. In that case, purchase price will be the value of benefit perquisite. and where the benefit perquisite provider manufactures such item, then the price that it charges to the customer, not the cost, sir, then the price as it charges to the customer for such item shall be the value of such benefit or perquisite. Fortunately, it is written, it is further clarified, GST will not be included for the purpose of valuation of benefit or perquisite of TDS under 194R. Question number 6. Many a time, social media influencer is given a product of a manufacturing company like an Instagrammer or a YouTuber, so that he can use that product and make audio or video to speak about that product in social media. Is product given to such influencer is a benefit or perquisite? Circular said, if the product is retained with such person who is an influencer, then it is his income. If it is returned, then it is not an income under 194R criteria. Whether reimbursement, this pertains to all of us. Please listen to it very carefully. Excuse me. Whether reimbursement of out-of-pocket expense incurred by service provider in the course of rendering service is a benefit or perquisite or not. Say for an example, Jitendra ji executed a project for a company under which he was supposed to travel from Mumbai to New Delhi and come back to Delhi. So this traveling expense could either be incurred directly by the company or could be incurred by Jitendra ji and then reimbursed by the company. Or Jitendra ji could have booked the tickets on his own, but directly in the name of company. 3 scenarios I am trying to put up because these 3 scenarios are given in the answer. Very interesting answer. And to make it cautious for all of you. Any expenditure which is liability of the person carrying out business profession, if met by the other person, is in effect benefit or perquisite provided by second person to the first person in the course of business profession. Now suppose if Jitendra ji is going to Delhi from Mumbai through traveling, then whether the expenditure on air ticket is liability of Jitendra ji or is it the liability of the company? In my opinion, it is the liability of the company because they opted a chartered accountant like him to serve them. But government has a different understanding. They are exemplifying. Let us assume that a consultant, that is Jitendra Kothari ji, is rendering service to a person X, say company X, for which he is receiving consultancy fees. In the course of rendering that service, Mr. Kothari has to travel to different city from the place where he is regularly carrying on business profession. For this purpose, he pays for boarding and lodging expense incurred exclusively for the purpose of rendering services to X Limited. Ordinarily, the expenditure incurred by the consultant, that is Mr. Jitendra Kothari, is part of his business expenditure, which is deductible from the fee that he received from company X. In such case, the fee received by consultant is income and expenditure incurred on travel is expenditure deductible from such income in computing total. So what circular has envisaged? As if there was no arrangement for reimbursement, expenditure incurred on Mumbai-Delhi travel by Jitendra Kothari ji would be his expense. Okay. Now, if this travel expenditure is met by company X, it is the benefit or perquisite provided by X to the consultant. Sir, till date, we have been ignoring 194J, Jitendra ji, by Aditya ji, by giving the reimbursement bill separate to the fee bill. So we were excluding it from 194J scope.
Yes.
And we were suggesting clients are no need to deduct 194J. Now this circular is saying, ask your client to deduct 194R from you. Now this is ridiculous. Now if his travel expenditure is met by company X, it is benefit or perquisite provided by X to the consultant. Further read. However, sometime the invoice is obtained in the name of X. Now if Jitendra ji is obtaining the invoice for such particular service in the name of X, and accordingly, if paid by the consultant, is reimbursed by X. In this case, since the expense paid by consultant is incurred wholly and exclusively for the purpose of rendering services to X, and invoice is in the name of X, then the reimbursement made by X, being the service recipient, will not be considered as benefit or perquisite for the purpose of 194R of that. Now see what is designed, sir. It's really surprising. Circular is saying if Mr. Jitendra Kothari is asking the travel agent to give a bill in his name and then claiming it as a reimbursement from X, Mr. Jitendra Kothari will be subjected to TDS. But if Mr. Jitendra Kothari is asking the company, that is travel agency, to give the bill directly in the name of X, but paying it from his own pocket and then getting a reimbursement from X, then it is not subject to 194R. Further read it. If the invoice is not in the name of X and the payment is made by X directly or reimbursed, it is the benefit or perquisite provided by X to the consultant for which the deduction is required to be made under 194R. This, I think, is something which is not easily digestible, but it is there before you. Now, another question is, if there is a dealer conference and certain expenditure like this are incurred, then sir, what will happen? In that particular case, the circular says the expenditure pertaining to dealer business conference would not be considered as benefit perquisite for 194R. In case where dealer business conference is held with a prime object to educate dealers customer about any of the following or similar aspect: new product being launched, discussion as to how the product is better than others, obtaining orders from dealers or customer, teaching sales technique to dealers customer, addressing queries to the dealer customer, reconciliation of account with dealer customer. However, such conference must not be in the nature of incentive or benefit to selected dealer or customer who have achieved particular target. So sir, if there is a combined conference, combined session wherein some dealers are also rewarded, then to the extent those particular dealers are rewarded, that is 194R. But if it is a all India dealer meet, all state dealer meet, for these purposes, CBDT is of the view that TDS would not be applicable. Further, in the following cases, expenditure would be considered as benefit or perquisite for the purpose of 194R, that dealer conferencing. Expense attributable to the leisure trip or leisure component, even if it is incidental to the dealer business or conference. Expenditure incurred for family member accompanying the person attending dealer business conference. And expenditure on participant of dealer business conference for days which are on account of prior stay or overstay beyond the date of such conference. So this we have to be careful. Last two questions for discussion. Section 194R provides that in case the benefit of perquisite is in cash, kind, or partly in kind, partly in cash is not sufficient to meet TDS, then person responsible for providing such benefit or perquisite is required to ensure that the tax required to be deducted has been paid in respect of benefit or perquisite before releasing the benefit or perquisite. How can such person be satisfied that the tax has been deposited? See, where the benefit or perquisite is in kind, how would you ensure? Fortunately, one interesting thing written here. The requirement of law is that if a person is providing benefit in kind to a recipient and tax is required to be deducted under 194R of that, the person is required to ensure that tax required to be deducted has been paid by recipient. Such recipient would pay the tax. Now here recipient would pay the tax in the form of advance tax. The tax deductor may rely on any declaration along with a copy of the advance tax payment challan provided by recipient confirming that tax required to be deducted on benefit perquisite has been deposited. This would be required to be reported in TDS return along with challan. First time we can see that you are reporting such advance tax deposit by the payee in your TDS return. This year form 26Q has included provisions for reporting such transaction. So this is one interesting thing which you can find there. Last question, sir. Section 194R would be applicable from 1st of July 2022. So the question comes that what about, I read it, 194R provides that the provisions of this section does not apply where the value or aggregate of value of benefit or perquisite provided or likely to be provided to a resident during financial year does not exceed 20,000 rupees. It is now not clear how this limit of 20,000 to be computed for financial year 22-23. CBDT answer: since threshold of 20,000 is with respect to financial year, calculation of value or aggregate of the value of benefit of perquisite triggering deduction under 194R shall be counted from 1st of April 2022. So means limit of 20,000 is for the financial year, not from 1st of July. Hence, if the value or aggregate of value of benefit of perquisite provided or likely to be provided to a resident exceed 20,000 during the financial year for 22-23, including period up to 30th of June, the provision of 194R shall apply on benefit of perquisite provided on or after 1st of July 2022. And the benefit of perquisite which has been provided on or before 30th of June would not be subjected to deduction. Say for an example, a company X Limited has provided rupees 50,000 benefit to a chartered accountant prior to or up to 30th of June, on that 50,000, there would not be any TDS. Say 10,000 rupees further benefit provided in the month of July. On this 10,000, 10% TDS would apply, because in aggregate, the total amount provided to such person is 60,000. Again, sir, TDS would not be on the full 60,000, it would be on the 10,000 only. So, sir, this was the last question which I discussed on 194R. From my side, it is complete. Thank you very much for a patient listening. Now, if any questions, I am ready to discuss over them. Thank you. Jitendra ji?
Yes, sir. There is a question from our participant.
Okay, sir.
Just in the chat, he wants some clarification on question 9. So can you please take us to question 9 and explain us it in detail?
Why not? Why not? I will take it again. Just a minute. This one is question 9. Okay. I read it.
Yes, sir.
So question 9 says section 194R provides that benefit of perquisite is in kind or partly in cash, partly in kind. But the cash portion is not sufficient to meet the TDS. Then the person responsible for providing such benefit or perquisite is required to ensure that tax required to be deducted has been paid in respect of such benefit or perquisite before releasing the benefit or perquisite. This is the requirement of law. How can such person be satisfied that the tax has been deposited? Okay. Say for an example that you got a benefit of rupees 30,000, which is in kind, and TDS is applicable at the rate 10%. Now 3,000 rupees is liable. Say that benefit is in kind of 30,000 rupees value. Then from 30,000 rupees value, nobody can deduct TDS at the rate 3,000, that okay, let me separate one part of the component. It's not possible. So the alternate which is suggested by this circular is, please understand it carefully, that okay, you may ask that person to whom the benefit being provided to pay that particular thing 3,000 as advance tax challan and give that challan copy to you, which you will be filing the return, and in that return of 26Q, you will be reporting that challan detail that okay, I gave this benefit of 30,000, 3,000 was paid by the recipient, he gave me this advance challan, this challan copy is for your reference. So this is the suggestion which is given into this circular. And in last para, in the alternative as an option to the remove difficulty, if any, the benefit provider may deduct the tax under 194R of the Act and pay to the government. Aap chaho, so you can pay on your own also. That is, you may deduct. The tax should be deducted after taking into account the fact that the tax paid by him as TDS is also a benefit. That is, in that case, we have to take a call of grossing up of the amount. In the form 26Q, he will need to show it as tax deducted or benefit provided. So sometime you may do a gross up also when you don't want to collect the TDS from the other person. This is also a technique.
So, excuse me, sir.
Yes, sir.
So this last paragraph I did not understand. Means
okay, sir. This last paragraph says, suppose you don't want that such person, you are not asking that person to deposit tax on that 30,000 rupees. Okay. Suppose your relationship is such or your dealer is that important, you don't want him to deposit that 3,000 rupees and give you challan copy. And you are giving the gift, you are giving that particular benefit or perquisite in kind. So you also can't deduct because there is no cash involved. So now what will happen? You should do a gross up. Gross up means say 30,000 rupees multiplied by 100 by 90. This is the total benefit which you are providing. Out of that, say 3,333 is what you are supposed to deposit to the government, and 30,000 is the value of benefit which you provided. So your total expenditure would now be 33,333, which you can debit in your PN. I hope now I am clear. Am I clear, sir?
Basically, what he's trying to say, 30,000 is your net benefit.
Yes. Then you have to do a gross up.
So it is after TDS amount.
Yes. Yes.
So we have to gross up.
Yes. That is my suggestion.
Then And one of our fellow participants, Mr. Abhishek Kothari ji,
Right,
has,
sir.
has explained regarding the GST implication. I'll ask him to unmute.
Okay.
Hello.
Good.
Hello. Good morning, sir. Sir, my
Yes.
query is the example which you have given that the
Hmm.
client is providing you a car of rupees, suppose 15 lakhs. And what if this has to be treated as an income? Suppose if we charge, if we consider this as fees received, including GST. So whether TDS will be applicable under 194R or 194J then?
Abhishek ji, sometimes what happens, you don't know the answer, means I don't know the answer, but I raised the query. See, I said that, okay, first, I wish that with all of us, this kind of incidents should happen. That we
Okay.
all should receive a Honda City car in this manner or any other thing which we wish. So say 15 lakh rupees car is given to a professional. I'm not a GST expert, so I would also request Jitendra, if any GST expert in today's session, he may raise the hand and give the answer. In my opinion, this 15
Thing is in the
lakh rupees.
mind,
Yes,
Karthik Aryan received a 5 crores car from TCS,
Right.
this person, na?
right,
T-Series 1.
right. So, and you all are in and near about Bollywood only, so you can see all these things happening there. So my understanding is, suppose if a person is receiving something in kind which is forming part of his income, and which is, there are two things. I'm just assuming, Abhishek bhai. One, it is a consideration for my service, which I can charge in cash or I can charge in form of kind. If I'm doing so, in my opinion, GST should be applicable because I'm charging in form of cash or in form of kind. But when I'm not charging, other person is giving. This is a benefit. This benefit, whether it is also liable for GST, in my prima facie opinion, it should be no. But again, Jitendra ji, Abhishek ji, I'm not an expert on GST, so I can't comment here with full confidence.
Okay. Sir.
Therefore, I requested that somebody from GST background would be able to clarify it better. I'm sorry
Okay.
that I'm not in a position to answer.
Not regarding GST, sir. Just for this TDS provision, whether the client is providing car against the fees, so whether 194 will be applicable or 194J will be applicable.
In my opinion, it is now 194R. If
Okay, sir.
unless you are receiving your fees in kind. If you are
Okay.
receiving fees in kind, it is 194J. If you are receiving it as a benefit perquisite, then it is 194R.
Okay, sir. Yeah.
Clear?
Okay. Okay, sir. Thank you.
Welcome.
Any
Yes,
other
sir.
queries? And Nitin Kothari raised hand.
Yes, Nitin.
Yeah, just one question. The provider should be that our should be client. The person who is giving benefit should be our client. Like suppose in your example you said that like one of my clients suppose has given me car. That is okay. Suppose he is not one person who is not my client. He is my friend and he is giving his office for free to me use.
Okay.
Then whether it is then again this 194 will be applicable 194.
Oh, very good question, sir. Now, I would say that background is 28 clause 4. Okay. Now, 28 clause 4 background, because whenever this kind of dispute would arise, we have to always go, even if circular is saying any benefit or perquisite which you are receiving should be subjected to 194R. But I am saying background of 28 clause 4 is very important. Now, say if I am your friend and I am giving you an office for use, and I'm not availing any professional services from you, then whether this benefit of occupying that property is a benefit or perquisite arising on account of exercise of business or profession, Nitin bhai, my opinion, probably you would agree, is no. Because you are not providing me any service.
Okay, so service provider should be.
If I'm builder and I'm making a commercial mall, and I'm desirous of obtaining your services, I said, CSR, you please sit in my office. and perform your services so that I can also get maximum benefit from you. And there I deliberately provided you an office which has certain rental value. Yes, sir, it is 194R because you are also giving me services.
Okay.
I hope I'm clear, sir. Please
Yes, yes,
understand in which background we are receiving these benefit service. In my opinion, it is important. Now, since the payer is a businessman, suppose the friend, I'm your friend and I'm also a professional or I'm also a businessman. I'm not availing your services, but I'm a businessman. You are a professional. If you go by the language of section 194R related circular, this circular prima facie shows that TDS is applicable. That you need not to see under which section it is taxable, whether taxable, not taxable, we will decide. But once I'm liable, as per circular on a safer side, I'm liable for TDS. Conceptually, I'm not liable in my opinion.
Okay. It means, for example, you have given me a car to operate for my business purpose. I am using your car daily.
Right.
Okay, but you are not my client, so you are not supposed to deduct any TDS. But the car is given by my client, by a company to whom I am providing service. Then he has supposed to deduct TDS. Even he is giving. But then how the value will be determined? Suppose he has not given me, but he has given me only for operational purpose to use. Then how he will determine what is the value of the prerequisite?
Sir, these are really very practical queries which will arise on our way while we are dealing with section 194R. I am of the opinion that one, they have given that, okay, if say for an example, I'm using car of my client to perform certain services as I have to travel in Mumbai from one location to another location. But I'm using that car for his purposes only. So suppose he may say that, okay, since there is a benefit or perquisite arising on account of exercise of business profession, I should deduct tax at source. Now there are two things. One, how would you value that benefit? Because without value being there, there cannot be TDS liability.
Right.
So that value could be either a depreciation for the period for which you use the car. Whosoever use the car, the depreciation value could be there. Suppose a chauffeur is also attached to the car, then in that case, chauffeur value would also be a perquisite. Suppose if it is so that in a MOU kind of thing, it was previously written that to and fro expenses would be that of the professional, not of the client. But later client said that, okay, no issue, I will bear them. Then in that case, it is a perquisite. Once it is a perquisite or benefit, whether convertible into money or not, law is so rigid. In 28 clause 4, you have seen with me, it should be valued. How it should be valued? CBDT said fair market value. Fair market value, how do you evaluate? Say for an example, I am traveling between Parel to Jogeshwari on a daily basis. Then probably somebody may say, okay, if you were otherwise traveling through a Ola car, it could have costed you say 1,000 rupees and 1,000 jana, 1,000 ana, 2,000 multiplied by number of days. That is how it can be valued. These kind of things may come up.
So it will be a Pandora box.
Yes, it's a Pandora box. In my opinion, something which is not in monetary format, how can you apply TDS on there? But government did so because it wanted to enhance the scope of TDS, and 28 clause 4 was a failure for the government. Whereas government knew that people are taking advantage. And the biggest example are doctors. We as a chartered accountant are not that much beneficiary as the doctors are. And as these all insurance companies are giving huge fees, these sales companies are giving, MNCs which are into FMCG are giving huge benefits. And they are not deducting, they are not saying that because there was no requirement. But the beneficiary was also not offering in the ITR. So government said it is easy way to connect it through TDS. Now everybody will be on surface. But it is a tension for the payer.
Excuse me, sir, one question.
Yes, Utkarsh.
Sir,
yes,
I, as a CA, provided one professional service in March 23.
Right.
It is one-time service only. And the client got happy and gave me one benefit in April 23. So whether 194R is applicable in April 23 for the client or not?
Can you please repeat? When did you?
Suppose March 23, I provided a professional service to one-time
Okay.
client. It was one job work. And the
Right.
client got happy with my work. He gave my fees in March, but in April,
Yes.
he gave me one benefit, say car or
Right,
a
right.
mobile phone. So whether
Right.
194R will be applicable for that client in April 23?
Subhaji, this section, as I was reading before you, 194R is applicable before providing such benefit or perquisite. So when it was exactly the time, it was, in my opinion, April in your case. You
Yes.
provided in March,
Yes.
your services, but
Yes.
he provided you, say, remuneration as well as this benefit in the month of April. In
Yes.
my opinion, April 23 would be the right month for deduction of TDS.
So that the professional service and that vis-a-vis we have to see every year, or once it is established, it is established. Because in April 23, I'm not his CA or anything.
See, sometimes it happens that you provide service at X moment. At X moment, when you provided service, your bill is due. But you are not aware that with this providing of service, the other person may give you a benefit or perquisite also. If I go by the accrual method under PGVP, can you say that benefit or perquisite has accrued to you? Answer is no, unless it is provided to you. So such kind of benefit or perquisite should be taxable in the year of receipt, when you actually received it, because you don't know what the other person may provide to you as a benefit or perquisite. And if suppose that benefit or perquisite was bundled at the first day, then you can say it has accrued to you in the first year itself. That if it was so that, okay, we will give you 10 lakh rupees as compensation and we will give you, say, a car or a jewelry set or a gold coin, then if it was bundled, moment you provided services, then in that time it is 194J. It is not 194R. Am I clear, Subhaji? Subhaji?
Yes, yes, understood.
We said in okay in chat.
Okay, okay. Any other questions?
No, sir. Thank you. Thank you.
Okay, okay.
One question in chat box is the company owned car, if used for consultant visit to factory, what will be impact?
Sir, as I have already answered this kind of question, in my opinion, is it a benefit or perquisite provided by the company? If you see it in a larger perspective, it may appear. If you see it from the perspective of perquisite valuation under section 17, wherein it is seen that if a car facility is given to an employee for to and fro visit to the employment place, it is not a perquisite.
Correct.
If that is not a perquisite, how come this becomes perquisite? I'm just trying to take color therefrom. How can it be treated to be a perquisite? See, unless the client sends me a car to pick me up from my office and to reach to his location to provide him the services, it is his duty to do so. Otherwise, he will reimburse me my expense, or I am assuming that, okay, he will either pay me my bills or my fees includes of that particular expense which I am incurring. But if it is his duty to pick me up from my location and to take me to his office and then again drop me on my residence or my office, I don't see it is a perquisite. So if it comes on record that way that, okay, he charges me for that, he values it specifically, then these issues will crop up. Otherwise, they will not crop.
And you can always argue that it is wholly and exclusively incurred for the purpose of business, and so it is not a benefit or a perquisite provided to the professional, and that is why 194R is not applicable. It is deductible under section 37(1) itself, and that way we can argue. Because I guess the compliance is on the deductor, and so companies will have to always take a stand whether it is wholly and exclusively incurred for the business.
Right. So it's a Pandora box, Utkarsh bhai. Otherwise, it's not an easy section to give effect to. And as a professional, we are going to accept this challenge. Okay, let's deal with 194R.
And another question, sir, if we got something freebies, how can we, because if the tax is deducted, it is comes into the 26 years of mine, then can we take expenses against that?
Yes, Jitendra, if you see that circular, therein it is mentioned, like the example which I quoted in your case, that you visited to Delhi. Suppose your true and fro expenses of air travel was 20,000 or say 30,000 to make it above 20,000 rupees. Now, this 30,000 rupees, which are reimbursed to you by the company, law is saying that it is your income. So on one side, this 30,000 becomes your income. On other side, you will claim an expenditure. So net impact is zero. And any TDS deducted therefrom, in this case, you will be going to get a set off thereof against your tax liability.
And what about the things is provided by some insurance company to attend a seminar or kind of in the foreign?
There they are saying that if there is a dealer meeting, and
Yeah.
I treat that dealer meeting would include this kind of thing also, where the agents are invited to join a particular session for training, for annual conference, etc., so that company can tell them, okay, this is what we are bringing out and this is where we are standing. This kind of expense should not be treated to be benefit or perquisite. This circular is beneficial to that extent.
But the insurance companies is deducted the TDS on that.
That I guess they are doing it on a conservative side. If I can.
So once they do it, then it comes to the 26 AS in mind. And how can we take the advantage? Because we don't know what is the amount of the perquisites, or just we just got the amount from the 26 AS.
Sir, amount of perquisite is very clear. The amount on which they deduct TDS, that is your perquisite. Okay.
Yeah, that is okay. But we don't expenses any.
Now, since you did not incur expense, you are not going to claim any deduction. So the whole amount will be taxable in your hands.
Whole amount is the tax.
Yes, whole amount would be taxable.
So thank you very much, sir.
Sir, if a car is given as a settlement of debt, but the company is booking as an expense or something in their book, so 194R would be applicable?
See, sir, settlement of debt is a different thing as compared to providing any benefit or perquisite.
Because one of my clients has got a car in lieu of the amount outstanding.
Usually what will happen, Aditya, by experience, the debt says 30 lakh rupees, the car value is say 25 lakh rupees, generally lower side. Suppose you get on a higher side, that debt is 30 lakh rupees and we got a payment of the car value rupees 40 lakh.
40 lakh.
Now, suppose if that 40 lakh, 10 lakh rupees component is interest, then first that should be adjusted. Suppose that is also adjusted, and then there is 2 lakh rupees remaining thereof, which is paid extra. Ideally, it will not happen. 99.9% it will not happen. Suppose if it happens, then it is a benefit or perquisite. Yes, then you can say start 194R on that.
Thank you.
I think a lot of things you clear us. And I request our deputy convener Utkarsh Sharma to give a vote of thanks on behalf of Andheri Oshiwara Studies.
Thank you, Jitendra ji. Thank you, Anoop sir, for taking out time on a Sunday morning and explaining us these two new concepts in detail, right from the start, right from the law to the practical aspects. ITRU giving us in detail the practical difficulties that can be faced, and also 194R is still an evolving concept, and we look forward to hear from you once more and more clarifications are there. Many thank you, sir. Thanks once again.
My pleasure. Thank you.
Thank you, sir. Thank you.
Good day to all of you.